Welcome, everybody, to the Social Security Benefits Option webinar, How to Potentially Maximize Your Income. We're going to allow everybody just a few seconds to get in the room and then we'll get started. Welcome back, everyone. We're going to begin our Social Security Benefit Options, How to Potentially Maximize Your Income workshop. I'm Allie Swafford, and I'm going to be your instructor for today's course. Just a bit of background. They chose me to present on Social Security because I'm of an age that it's important to me in my life. I have a background of teaching. I've been teaching for over 30 years. I also serve as the president of Prosperity Partners Wealth Management. We are a local independent financial management company here in Knoxville, Tennessee. So we hope you enjoy this presentation, and if we can be of any assistance to you, please let us know. First of all, how does Social Security fit into your overall plan? Well, we believe there are 5 pillars of holistic planning. Certainly, financial planning, where Social Security fits in well. We also need to integrate that with the assets that you've accumulated. We want to make sure that we are tax aware, managing your taxes. We want to make sure that your assets are protected for both you, your spouse, and for future generations. And that leads us into legacy planning. So, yes, Social Security is essential in all of this. Our mission as a nonprofit organization is to inform and empower Americans to take control of their finances by providing financial education in communities nationwide. Here is our disclosure. The thing that we promise you today is that this is informative. It is an instructional presentation. There will be no selling or no pressure on our part for you to do anything except to gain the most knowledge that you possibly can. What is Social Security to the average wage earner? Well, for those of average wage, about 40% of your retirement benefit. For those of you who are higher wage earners, it's probably less than 40%. And those of you who may have been lower wage earners, it could be more than 40, but 40 is the average. Well, what does that tell you? Well, that means 60% of your retirement income needs to come from other sources. Examples would be retirement plan distribution. Maybe you have some annuities, a brokerage account, an IRA, a 401k, a 403b, other savings, and possibly real estate income. These are just some of the things that might make up that 60%. But 40% is a big number. You've worked a lot of years to accumulate that Social Security savings for you, so we want to make sure you use it effectively. How complex is Social Security? Lots of times people say, well, Allie, it's only take it at 62, which would be the first opportunity. Take it at full retirement, which for most of you is 67, or take it at the latest possible time, which is 70. 3 options, right? Well, if you look at this, there are actually 81 age combinations and more than 567 different sets of calculations to consider when determining how we're going to and when we're going to apply for benefits. Making the wrong decision could cost well over $100,000 during your lifetime. We've actually had people come in, even CPAs and their spouses, who, once we run our complementary Social Security analysis, say, oh, I was not even considering this as an option. So I would like to remind you that you are going to be presented the opportunity to individualize Social Security for you or you and your spouse with this comprehensive, totally complimentary Social Security report. More about that later. Will Social Security benefits be there for you? That's often what I hear. Oh, I'm going to take my benefit at 62 because Social Security is not going to be there. Well, let me assure you, Social Security will be there. Now, will we necessarily get 100% of what our Social Security statement projects? Possibly not. And you'll see when Social Security potentially, the trust fund could run out. As you see on the slide, 2035, there's not going to be enough to pay 100% on the dollar, but about 85%. So, what are some of the things that could happen? Well, what if we increase payroll tax from 12.4 to 14.4? What if we move that age up from 62 to 65 to coincide currently with Medicare for the first time you could take Social Security? And don't worry, for those of you who are close to 62, Social Security has a way of phasing in these options. If they do make some changes, it's not going to be here we are in 1 month and it's going to start next month or even within the next 6 months. But raising that age from 62 to 65 is the minimum. Possibly even raising the last time that you could take Social Security from 70 to match maybe required minimum distributions. They too have risen from 70 and a half now to age 73. And for those of you born after 1960, 75. So does it not make sense that maybe Social Security should also recognize that we are living longer? And of course, the system was never designed to be all of anyone's retirement income. In fact, when it first came out back here in Ida Mae Fuller's day, it was designed as to be for disability and for those who lived longer than life expectancy. So here's Ida Mae. She was a legal secretary in Vermont. She put in 3 years worth of contributions for just under $25. She began receiving her Social Security of $22.54. She lived to age 100, and over that period of time, she collected $22,888.92 from Social Security. So you can see it really was designed for those who lived long or who had a disability, not for people who were using Social Security as their main source of retirement because life expectancy was 65 at that point. So, what are retirees asked today as we're going through those 5 pillars of planning is, will I have enough money? Will I outlive the money that I have? 42% of Americans are concerned about not being able to maintain their standard of living. Think about that. We call this the golden years. We work our entire career, possibly 30, 40 years, to have the golden years, and yet the number one concern is, will I outlive my money? Here are some of the things that you want to consider. Will my expenses increase faster than my income in retirement? Inflation is a big topic we hear a lot about, so that may be. What will market volatility do to affect my lifestyle? How many of you know somebody who retired in 2007 or 2008 through no fault of their own, just the market volatility taking back? I call it the double bear. Not only were they pulling money out, which was what was intended to happen, but the market had taken away a vast amount of what they had accumulated. So, what's market volatility going to do in the future? We've had an awfully good run here for the last 2 or 3 years in the market. It's normal for markets to pull back, but if you're retiring right at the time that we have a downturn, have you planned for where we're going to get the income to fill that gap? Will I be able to pay for my healthcare expenses? Boy, if that's not the hottest topic, healthcare expenses, long-term care costs are going through the roof. So once again, you've worked a lifetime. Have you planned for these what ifs? We'd all like to be Goldilocks and everything's going to just be perfect, but life has a way of throwing curveballs. And you need to make sure that you have planned in all those 5 pillars, integrated Social Security into your plans, and looked at things like how do I balance the needs of my family? We hear more and more that, there are people living longer and that there are folks coming through college that just can't find a job. So some of us may be in that quote sandwich. We've got parents that we're trying to help. We've got kids that we're trying to help. And by golly, I'd like to retire someday. So will you outlive your money? The big question is how much money do you have now? Well, many of us have different accounts, different pieces of money that all play into that puzzle that goes along with Social Security. But let's just think back. Do you have a partner with possibly the highest value account you have, which is probably your 401k or your IRA 403b? For most of us, we accumulated that amount of money on a pre-tax basis. We were putting in money. Hopefully, our employer was doing some type of a match. Good news. We didn't have to pay taxes on that money when it went in. What's the bad news? If it was pre-tax money going in and we accumulated $1 million, do we really have $1 million to spend on ourselves during retirement? No, 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 no. Whatever tax bracket you're in, let's say the 22% tax bracket. Well, what does that mean? You have 780,000 because 220,000 is going to our favorite uncle, Uncle Sam. Well, let's just look at this little Pickles cartoon. What's the matter, Earl? You look a little down. According to statistics, I have a better than 50% chance of living to the age of 87. Well, what's wrong with that? I can't afford to live that long. We don't want that to be you. We want to make sure that you have integrated Social Security with your other assets so that you can have that golden retirement. Let's get down to a little bit of nuts and bolts. You've all seen your Social Security statements. Now, they've changed the statement, and there are some things I like about the new statement, some things I don't. Yes, they've given you projections of several different age amounts on the statement, as well as they've summarized your earning history that was subject to payroll taxes. The old statement used to give you a year by year breakdown. I've actually had people say, well, look at that. In 1995, they've got a zero for my earned income. I know I was working in 1995. So there can be errors, but you, the taxpayer, are responsible for finding where those errors are located and working with the Social Security Administration. Now, yes, there is an estimate of your benefits, but no, there is no cost of living factored into these estimates, which is one of the values of having our complementary Social Security analysis done because we can plug in. Do we think there's going to be 2% cost of living going forward? 2.5, 1, 0, whatever you want to put in, we can put that in. And of course, the number one thing people always ask me is, Allie, when should I take my Social Security? And I tell them, you tell me when you're going to die, I'll tell you when you should take your Social Security. So remember that. If you have a history, my dad lived to 92 and he had a much harder life than I have. So my thought process is with good medicine and with me taking care of myself, I'll probably exceed that. So when I say, when do I think I might pass away? I'm probably going to boost it out to 97. That has an effect on when I will take Social Security. And the same thing should be for you folks. So let's take a look. If you've not set up your Social Security account online, do so. Right on the screen is where you can see where to set up your account. You can review your Social Security. As I mentioned, you can go deeper in the report and find that year-by-year calculation. You can review what they think your benefits are going to be. You can update addresses. You can change a deposit date if you start taking Social Security. So you really can have more control. But remember, you do have a physical Social Security office as well. I always tell people I could throw a rock and hit the Social Security office from our office in West Knoxville. So again, make sure that you are aware of what Social Security has listed for you. Now, we're going to talk about eligible versus entitled. Who is an eligible worker? Well, it's a worker that's accumulated the minimum number of credits for Social Security. And that minimum number of credits is 40 credits, which is about 10 years of work. If you have worked 10 years where they took the deduction out of your wages, then you have your own Social Security amount. You also must be age 62. Now, another interesting fact here is people say, well, I have a defined benefit plan, and they look at my last 5 years to calculate what my benefit is going to be in my retirement. Social Security looks at 35 years. So when we say, what's the minimum credit? 40, which is quarters, so 10 years. But know that in order to maximize Social Security, 35 years of work is really what we're looking at. And if you don't have 35 years, you get a 0 plugged into the calculation when they're determining what your primary insurance amount should be. So that's a real important factor for many people. They're 62, but maybe they've only worked 8 years, or they're older than that and they want to increase their benefits because you can increase those benefits even working longer than full retirement age because it replaces some of those lower 0 numbers. Well, who is an entitled person? An entitled person is someone who's applied for their benefits, whether or not they're receiving them or have suspended them. And you're going, why in the world would anybody suspend their retirement Social Security benefits? We'll get to that. All right. Now, for any of you who worked for the government in any form, you have been very familiar with this WP and GPO rule, which really said, you might not be entitled for all the benefits because we have had benefits through our federal or state government work. Well, January 5th of 2025, President Biden signed legislation that modified these rules, and the result of that was it reduced the impact on retirees and made the provisions far more advantageous for those workers. Now, they went back and rectified that situation. So if you were one of those folks, you've seen some changes in your Social Security. Cost of living adjustments. As I mentioned, when you see your Social Security report, the government does not factor in COLAs because they're not guaranteed. Now, how do they figure out whether they're going to assign a COLA or not? It's based on inflation. So look back to 2023. We can remember those days, and when inflation was high, it was really high. 8.7% was the COLA increase because inflation was so high. And this goes from third quarter to third quarter. So every October, we kind of know that number. The number for 2026 is 2.8%. So, yes, benefits are going up from 2025 to 2026, but guess what? Costs for Medicare deductions are also going up. And for some people, that amount is even higher than the increase you're going to see in Social Security. So, again, this is not a guessing game. You really need to sit down with somebody knowledgeable in Social Security that can integrate this piece of your important financial plan into all five of those pillars. Now, right now, what has been the average increase? Since 1975, they're going to tell you 3.6%. In our calculations, we would rather be conservative and we'll normally plug in about 2% or possibly 2.5% if that's what you'd like to see. So back at the beginning of our presentation, I mentioned a couple of ages that may sound familiar to you. So the earliest age you can take Social Security is 62. But remember, I call this the penalty phase, and you're going to see what I mean in the next couple of slides. The next one I call the Monopoly Go number. That's full retirement age. Still, there are some of you 66 and 10 months, that type of thing, but most of you are probably 67. And you get your full benefit. Again, Monopoly, you passed Go. And then there's those of you who like that bonus. I always like bonuses. Well, you get a bonus of 8%, 8% from full retirement age to age 70 if you use those delayed retirement credits. Now, what are the pros and cons? Well, obviously, if you're 62, you're getting your benefit early. So there's some money. And I'm not saying that that's wrong. Again, what we want to do is analyze your situation. That Social Security comprehensive analysis report is invaluable. I've seen people who thought they were going to wait longer, but because their spouse's benefit was so much higher that it just made sense for them to start theirs at 62 to have some income coming in. But that's not everybody's situation. Because, of course, the con is this is absolutely going to be the smallest check possible. And if you are intending to be employed, it could even result in a penalty where Social Security keeps a portion of that check. Well, that wasn't your objective. So let's try full retirement age. Remember when I said monopoly? Okay, we passed Go. You're going to get that higher monthly check based upon those 35 years of earnings. And you can now be employed and earn whatever, 100,000, 300,000, earn it. You can still get your full check. Well, what's the disadvantage? You didn't have benefits between 62 and your full retirement age of 66 and some months or 67. Now, that bonus, age 70, it's absolutely going to be the highest monthly check. There's no penalty if you're employed. I mean, I plan with people every day and we try and put in What do you think is a realistic projection of what your investments back to your IRAs, your 401ks, your annuities, what are they going to earn? Do you think I could guarantee an 8% per year, every year return? No. Well, that's what Social Security is saying is if you can wait. So let's get back to me. Yeah, why not? If my dad lived to 92 and I'm going to live to 97, would it not make sense for me to get that highest monthly check because I'm going to live longer than average life expectancy? So think about that. Think about family history, think about your own health. Think about other sources, and that's why it's so important. Sometimes planners don't look at Social Security, it's not within their area of expertise. We look at everything. How do we fit all those assets together to make some of those tough decisions? So, here are some important definitions that you need to be aware of. The first one is called deemed filing. It requires that a claimant filing for any benefit must file for all benefits available to them at that time. There you go, that's kind of confusing. Well, let's say you have Social Security on your own work record. Well, that's one benefit, but you may also have Social Security as a spouse. Well, what this is saying is if you go to Social Security either online or in person and say, I want to apply for my benefits, they're going to look at what are you eligible for? Maybe it's because you're a widow. Maybe it's because you're divorced. All of those factors and try and determine what is going to be your highest benefit. Now, remember, we talked about why would anybody voluntarily suspend their Social Security? Well, first of all, you have to get to age full retirement before you can do that. But I'm just going to give you an example. Let's say at 62, you said, whew, enough is enough. I'm going to go ahead and retire because I have so many household projects that I need to do. We call those honey-do lists. So we start on the honey-do list, we clean out the attic, we clean out the garage, we repaint, we put up a fence, we get a new storage building. Well, now guess what? The honey-do list is gone. May like to play golf, and when I only got to play golf on the weekends, it was a lot of fun. Now that I can play golf 7 days a week, or in my case, pickleball, well, it's not quite as much fun as I thought it was going to be. It was kind of fun having a group of people that I interacted with. I think I want to go back to work. Or your spouse may say, whoo, 24/7 of you, I want you to go back to work. Well, if that's the case, when you get to full retirement age, you can suspend that benefit that you turned on at 62. Now, why would you do that? Because you want those delayed credits, that 8% per year from age 67 to age 70. 8, 16, 24. But you don't have to wait till 70. You can turn it off and turn it back on anytime in between. And remember, Social Security is not a year to year. Social Security increases month by month. So, what's the downside of that? Well, if your spouse was receiving benefits on your benefit, they can't continue that. Their benefit would be suspended too. So again, it's not right for everybody, but there are circumstances where that makes a lot of sense. Now, here's a slide where everybody says, oh, all financial planners say Social Security should be delayed until age 70, and you should utilize your assets until age 70 to bridge from retirement until you get that later benefit. We don't say that. We say, let's look at your individual situation. Now, what did I say about why you should turn on Social Security? Well, first of all, if your health is poor. You know, I don't have that long to live. You earned that Social Security. Turn it on at 62. If you don't think that you're going to kind of cross that break even threshold, and most calculations will show that it's somewhere around 78, 79 years, then you need to talk to your planner. Let's look at this. Does it make sense for me to take Social Security now? What if you were one of those wage earners that, boy, I need every dime I've got? Right now, we have so many people in crisis, not able to meet their everyday living expenses. If you really need that Social Security to maintain a standard of living, maybe you need to go ahead and turn that benefit on. So there's reasons to turn on Social Security early or maybe earlier than full retirement age or 70, and we need to know those. Include that in your plan. Then may be some of you who were high wage earners and maybe your spouse was a little bit lower wage earner. Kind of a rule of thumb is whoever has the largest Social Security benefit should be the one to turn it on later rather than earlier. And why would I say that? Well, some of you may know and some of you may not. When one spouse dies, one Social Security benefit's going to go away. It's going to be the lower benefit. So if we've got one spouse that has a really high Social Security amount and the other spouse maybe has a lower amount, well, if the lower amount spouse dies first, yes, that lower benefit goes away, but they maintain that higher benefit. But what if the higher amount spouse passes away? Once again, the lower benefit goes away, the higher benefit remains. So you're not only planning for yourself, but you're planning for your spouse as well when we're doing Social Security retirement planning. Now, we mentioned what are some of the good things and bad things that happen with continuing to work. Well, in 2025, the earned income limit was 23.4. That's adjusted for inflation in 2026. But the idea is if you are going to continue to work and your income exceeds the threshold, then the government is going to withhold $1 of benefits for every $2 earned above this limit. You know, I had a client who was just excited to come in and say, "Oh, I'm turning 62. I'm going to turn on my Social Security. That, along with my employment income, I am going to be set." Problem was their income exceeded the limit, and so they were going to have that $1 for every $2 withheld. After evaluating it, said, "No, I think I'm going to wait for that monopoly full retirement age." Now, in full retirement age, look at that number. Again, 2025's number was 62,160. That means if you earn that much before the month of your birthday, they're still going to withhold a little bit of your benefit. I often laugh and say, how many of you were born in January? Of course, we're assuming just a calendar year. One hand will go up and said, you won the lottery. You can earn 62,160 the month before and still get your full benefit. My birthday's at the end of November, so I only have that 62,160 or the adjusted amount in 26 to earn before November. But remember, after full retirement age. So again, let's just use 67. There's no limit on earning. So turn on your Social Security, or you may say again, I can't average that 8% return. I'm going to let those credits accumulate until the latest time, which is age 70. But if you're 70 and haven't turned on your benefit, shame on you. It's not ever going to get better based upon your work record. Although if you do work after age 70, it still can help your record if that later working years provides higher benefits of your 35 highest benefit years or income years. Now, here's one that just frosts so many people. Provisional income. What in the world does that mean? Well, provisional income is the sum of all your income that you had. Let's just use 2025 as the example, plus half your Social Security income, and it also includes tax-free municipal bonds. So what do? They take half of the Social Security income. So let's say you were getting $3,000 a month. They use 1,500. That's half of what you were getting. Then if you are employed, you add your wages to it. If you're getting distributions from your 401k, your IRA, if you get dividend income, you get interest on tax-free municipal bonds, capital gains, if you're getting a pension payment, and taxable portion of inheritance. And people go, whoa, taxable portion isn't, the inheritance amount up there around $15 million. I'm not in that league. What that means is, let's just use an example. Let's say that your mom took out a tax deferred annuity for $100,000 and she was so excited because it was deferred. She never had to pay taxes on that money year to year, and yet, oh boy, when the statement came, it was going up. Well, mom passed away. That 100 all of a sudden had turned into 200,000. Well, what happens to you inheriting that $200,000 tax deferred annuity? That 100,000 that didn't have tax that mom was so excited about, guess who has to pay the tax? You. So that's where this comes into this provisional income. But here's the rub on that. This calculation has not changed since 1985. 1985. So let's go over to the married filing jointly column. Let's just say that what you had in provisional income was $40,000. Well, you'll see that falls in that middle bracket of 32,000 to 44,000, which says you're probably going to pay 50%. What that means is that you are going to pay in your tax bracket, not a 50% tax bracket, but your tax bracket on 50% of your taxable benefits. Well, then let's say, remember what I talked about, when one person dies, let's go over to the single filing. Still need that $40,000, but now what's the problem? As a single filer, that's over 34,000, which means the taxable portion of Social Security will be 85%. So we often say when one spouse passes away, typically income goes down. If we had two Social Securities, we have one. If we had a pension, possibly part or all of one of the pension goes away. But what happens? Look at this. Taxes go up. Again, a planning opportunity, and part of those 5 pillars. Tax planning cannot be left out. You know, all the years that we were accumulating money, people said, oh, you're going to be in a lower tax bracket when you retire. Maybe, maybe not. So we need to have integrated financial planning. Now, of course, one of the big myths was that when the one big, beautiful bill, OB3, was passed, that Social Security was not going to have any taxation. Well, now for some people, that worked out. So let's talk a little bit about how that works. So there is a new senior tax deduction, and I hope those of you who are planning on your taxes for 2025 looked into this, because if you are married filing jointly and your income was under 150,000 for couples, if you were single, 75,000, then that deduction, the 6,000 per person. So if you're a couple and fall into that under 150, $12,000, but you have to be 65. So, what about those Social Security recipients between 62 and 64? Nope, that didn't affect you. But we have a window of opportunity for people who are 65 plus because 25, 26, 27, 28, these years, if we fall under these eligibility standards, then we are going to see some opportunity for planning. Once again, this is not a dartboard. You need to plan and see what we can do to control that income. Now, there are phase outs for singles. It goes between 75 and 175. We'll show an example. Couples from 150 to 250. So let's take Bob's profile. He's a 69-year-old single filer. He gets 25,000 from Social Security, 45 from part-time consulting, 8,000 from investment income. So his modified adjusted gross income is 78. Now, what did we say? For single people, 75 is the max, but it's not an all or nothing. So we take the 78,000 that Bob earned minus the 75,000 limit. He's 3,000 over. So phase out 6% times 3,000, reduction of $180. But still, if we have 6,000 minus 180, we're at $5,820, which is a tax savings of $699 in the 12% tax bracket. So that's not insignificant. Let's take Jim and Sherry's profile, 67 and 65. They're filing jointly, so remember that 150, and we phase out between 150 and 250. So there's 42 from Social Security, 100 from pension and part-time income, 15 from investments, total marginal adjusted gross income 157. 157 minus the 150, there's 7,000 over. So we take 6% times 7,000. So it's a reduction of $420. So remember that deduction is per person. So 6,000 minus 420 equals 5,580. They each get that deduction because they fall in that 65 plus. So the deduction is 11,160. They save $2,455, assuming they're in the 22% tax bracket. So here is how that really came into play and why you need to sit down with somebody and take a look. Take a look if you haven't done your taxes for 2025, and certainly be mindful in 26 until this expires. We want to take full advantage of every deduction that's out there. Now, spousal benefits. Those are always a question, and people say, well, who gets that spousal benefit? Well, the first thing is you must be 62 or have a qualifying child in your care, and you have to have been married for at least 1 year. That qualifying child means a child age 16 who receives Social Security disability benefits. If you elect to receive a spousal benefit before you reach your full retirement age, your spousal benefit will be permanently reduced unless you have that qualifying dependent child. And where this slide comes from, as many of you have heard, okay, if I'm eligible for a spousal benefit, I'm going to get 50% of what my spouse's full-time retirement age benefit would be. Well, there's two parts to that that may not be true. The first thing is, a lot of folks have said, well, my spouse delayed until age 70, so I'm going to get half of his or her age 70 benefit. Nope. It's half of the full retirement age benefit. And here's the other assumption, is that you have reached full retirement age. So if you take that penalty phase somewhere between 62 and let's just use 67, you will not get 50%. It is a permanent reduction because you chose to take it early. So here's kind of how that looks like. All right, the maximum is 50% of your spouse, and don't forget ex-spouse may be an option too. Primary insurance amount. What's the primary insurance amount? Their full retirement age. They're going to look at, is your benefit higher than 50%? So for those of you who have both worked, and we've got a lot of two-career folks these days, your benefits may be very close or certainly not far apart. So, again, you're going to file on your own benefit. And that big reduction, look at that, 32.5% if you take it at the earliest possible time. So get some help. Don't just do this on your own. Well, what about the event of divorce? Now, I know I'm going to age myself, but how many of you remember Johnny Carson? Funny guy. Oh, loved it at late night. But what was Johnny known for? Not only being funny, but he had a lot of ex-wives. So let's just use this in Johnny's case. First off, you must be 62. You have to have been married for 10 continuous years. Now, I had somebody come to the seminar and said, we were married 5 years and whoa, we decided the grass was greener. We were out there for 2 or 3 years and said, no, it's not greener. And they got remarried. Another 5 years go by. Are they eligible for that divorce benefit? No. They had 5 years continuous break and then the additional years. So it starts over again on that remarriage. And again, you are unmarried. So if your ex-spouse is receiving Social Security, retirement, or disability benefit, you meet those criteria. 62, you were married 10 continuous years, you're unmarried, then you're entitled. But, not all divorces are amicable. So Social Security created the independently entitled. Now, this gets a little complicated, so bear with me. Without your ex-spouse being entitled, which means your ex-spouse could potentially still be working, your ex-spouse could have remarried, all of these types of things. So, we're going to say he or she is entitled. And so you are single. Both you and your ex have reached at least 62. Your divorce is over 2 years old, and your ex-spouse doesn't even need to know that you've applied for benefits on his or her record, and their current spouse is not negatively impacted. So here's some of the ways that you really need to keep an eye on benefits. We had a lady come to our seminar. Her mom was up in Chicago. Her mom and her father were married very young. They met this criteria. They were married for 10 continuous years, but then they split up. Her biological father became very, very successful. Her mom raised kids and did not have much of a Social Security record. She was surprised to find out, since her mom was single, that she met all of these criteria. She was single, she was at least 62. The divorce had been final for many, many years. Her mom could file on her biological dad's benefits, a great boost to that family situation only by knowing the rules. So know the rules. Well, what about survivor benefits? If you're a widow or a widower, you're eligible to collect either your own benefits or 100% of your deceased spouse's benefit, whichever is greater. Now, here's where that age limit goes down to 60. But remember, there's always a penalty. But I say to people, if you have no other means of income and you are 60, you were married for at least 9 months or 10 years if divorced, you're unmarried after the age of 60, if you need those funds to keep you in a lifestyle, then go ahead and apply. But again, if you're still working and don't necessarily need those benefits, you want to again look at what's the difference in what your benefit would be and what the survivor benefit would be. We want to make sure you maximize whichever works best for you. So this slide is a little bit old, but the thing that I want to hop out for all of you is look at this. In 2024, if 101,000 people made it to the age of 100, I plan to be among those when my time comes because I love that Smucker's commercial. Now, I don't think Willard Scott will still be around. He's a little older than I am, but I loved it. Allie Swafford made it to 100 years old by playing pickleball, whatever it may be. But anyway, ladies, 78% of women were the ones who made it to that age 100. Now, I've got a partner that says, hey, he happens to be male, we don't want to stick around that long. But hey, ladies, if we're still here, we want to make sure that we don't run out of money. And that's why this planning is so important. And it's not just Social Security as an isolated benefit. Make sure that you're looking at all aspects. Make sure that your advisor takes into consideration everything that's going to come into play because that's what gives you that peace of mind that we all want. Because what if we are one of that 25% that lives to 97 or even beyond? In many of my classes, I ask people to raise their hands. How many of you have a relative that lived to at least 90? And several hands will go up. Then I'll say, how about to 95? A few hands will go down, and I'll say, how about 100? And normally there's still a hand or two, and they'll say, yes, I have a parent or I had a grandparent that lived to over 100. So we want to make sure that we're maintaining our lifestyle and our dignity at whatever age we attain. So we always get to this point and we say, well, will I outlive my money? 44% of baby boomers and Gen Xers are projected to lack adequate income for their basic retirement and health care expenses. Well, how do we know? Well, the first thing to do is to look at what are your current income needs. And then what do you think your needs are going to be in retirement? Is there a gap? And of course, we need to close the gap between the two. It is a puzzle, and we've got to put all of those pieces together. Now, probably most of you have sophisticated online systems where you enter what all your expenses are, what all your income is, and you can determine that gap. But for those of you who don't, we do have a workbook that'll at least give you some guidelines. And what I would like to say is don't forget things. I happen to have a dog and a cat. Let me tell you, my vet bills, food bills, shelter bills, all those things for my wonderful dog, furry children is an essential item of what I would need to put into my retirement income. I had a lady come in and she had relatively short hair. And I said, oh, you've decided to grow your hair long in retirement. She said, well, no, why? I said, well, there's not a single thing in there for haircuts, going to have your nails done, any of those types of things. So don't forget the little things is what I'm trying to say. Most retirees will need between 80 to 100% of their pre-retirement income in order to maintain their lifestyle. We had a client come in that said, I planned well for the purchase of my toys in retirement, I just didn't plan how expensive it was to use my toys in retirement. So if your dream is to travel across the country in a wonderful big rig, make sure you include how much does it cost to run that big rig across the country. And don't forget, Social Security was never designed to be the majority of what was going to be your retirement income. So we need to prepare for a comfortable retirement. You need to look at everything that's in your entire financial picture. Now, that may even include inheritance, and certainly we can't put a date or a time on that. But in using planning software, we can include all of these things. Do we still have children that are going to get married? Do we think we want to travel? And what's that number once a year? If we've got health issues, how might that impact things? What do you have in your 401k, in that brokerage account? What kind of rental income and how long do you want to keep running those properties? What do you want to leave as kind of that legacy for your children? So don't forget, Social Security is not an isolation. It goes into that financial planning. It goes with asset planning. What asset are we going to use first? Remember that white horse, black horse? Taxes. Oh my goodness, that is going to change dramatically for you over the course of the next few years. So we need to be very tax aware. What about protection? When that one spouse dies, have you planned? Do you have adequate protection to keep that second spouse in their lifestyle for the rest of their lives? And what about legacy planning? I hear so much from my clients about I want to make sure my grandchildren are educated. I want to have experiences with my family. So we can look at all of this as we run that complimentary Social Security report for you. Invaluable, no cost to it. We just need a little bit of information from you. And we're more than happy to provide you with a 20-minute Zoom strategy session or a 1 hour free consultation. You can schedule with us here or go online and do that. And what are we looking for? We're looking for what's important to you. What is it that keeps you awake at night? What are the 2 or 3 financial priorities or objectives that you want to accomplish? What questions have you had? And then, of course, what resources have you put aside to help you accomplish these goals? You know, all we're trying to do through our education is to bring value to you. We want to make sure that you feel in control. There's no better feeling than to say, whew, I know how my future looks. I know there will be bumps in the road, but I have planned and I have insight into my full financial future. So, with that, I'd like to say thank you for attending today. You can follow us on social media. Certainly, you can contact us at any time. Our goal, we are a firm dedicated to education first, bringing value foremost. Thank you for joining us for this workshop. This is Allie Swafford saying, have a great day. Bye bye.